There is a secret language spoken by the truly wealthy, a dialect of decision-making that is entirely foreign to the average person. It's not taught in business schools, and it's certainly not preached by the commission-hungry brokers on Wall Street. This language has very few words, but the most important one is no. The second most important is more. This is the language of focus, of placing massive bets on the vanishingly rare certainties you uncover in a world of noise. And for the last 60 years, its most fluent speaker has been Warren Buffett. Most people think Buffett's genius lies in what he buys. They are wrong. His true, world-altering genius lies in what he doesn't buy. It lies in the thousands of companies he has studied and rejected, the hundreds of good ideas he has passed on, the deafening silence of his portfolio for years at a time. While the world frantically trades, chasing tips and trends, Buffett sits in his office in Omaha, reading, thinking, and waiting. He is waiting for what he calls the fat pitch, the one perfect, unmissable opportunity that comes along only a few times in a decade. And when it comes, he doesn't just take a tentative swing. He swings for the fences. He invests a fortune. This philosophy, this entire operational system for wealth creation, can be distilled into a single, powerful mental model. It's a tool so simple a child could understand it, yet so profound it has built the single greatest investment track record in human history. He calls it the 20-slot punch card. Imagine that when you are born, you are handed a small cardboard ticket with just 20 punchable slots. Each time you make an investment decision in your entire life, buying a stock, investing in a business, acquiring a piece of real estate, you have to punch one of those slots. Once all 20 are punched, you can't make any more new investments. Ever. That's it. 20 chances to build a lifetime of wealth. Suddenly, the game changes. The casual $50 flyer on a biotech stock your friend mentioned? That's a punch. The hot tech IPO everyone is talking about? That's a punch. The casual, diversified mutual fund with 100 different holdings you don't understand? That's a punch. How carefully would you guard those precious few slots? How much research would you demand before committing one? How certain would you have to be? You would treat each decision with the gravity it deserves, as a permanent, life-altering commitment. You would stop being a stock collector and start being a business owner. You would stop speculating and start investing. This isn't a cute metaphor. It is the genetic code for building a fortune. It is the firewall against the single greatest destroyer of wealth for the retail investor: over-diversification. Wall Street sells you diversification as a safety measure. They tell you not to put all your eggs in one basket. What they are really selling you is guaranteed mediocrity. By spreading your money across 50 or 100 different stocks, you ensure that your winners will be canceled out by your losers, and your portfolio will do little more than hug a market index, all while you pay fees for the privilege. The punch card philosophy is the antithesis of this. It forces you to find your 1, 2, or 3 best ideas and bet on them in a way that can actually change your life. It's a mandate for high-conviction investing, a blueprint for transforming your financial future, not by making more decisions but by making vastly fewer and infinitely better ones. Today we are not just going to talk about this idea, we are going to dissect it, layer by layer, until its logic is branded onto your own decision-making process. We will explore the philosophy of extreme focus that underpins it, the brutal discipline of no it demands, the obsessive due diligence it requires, the raw courage needed to concentrate your capital, and the long-term partnership mindset that turns a stock purchase into a lifelong source of compounding wealth. This is the final promise of true investing, not just to make money, but to build a fortress of financial freedom, one carefully selected punch at a time. Our journey into this radical approach to portfolio management begins with understanding its core. This isn't a mere tactic. It is a complete worldview, a fundamental recalibration of how you see opportunity, risk, and capital itself. It's the philosophy of extreme focus, where the punch card isn't just a tool, but a constant physical reminder of the immense value of each decision. And there is no greater story to illustrate this philosophy in action than Warren Buffett's baptism by fire the one bet that put his entire nascent career on the line and forged his conviction in the crucible of a national scandal, the great salad oil scandal of 1963 and his audacious investment in American Express. To understand the magnitude of this moment, you have to transport yourself back to the early 1960s. Buffett was not yet the Oracle of Omaha. He was a young, sharp, but relatively unknown money manager running a small investment partnership out of his home. His investors were family, friends, and neighbors, people who had trusted him with their life savings. The pressure was immense. In November 1963, the financial world was rocked by a scandal of epic proportions. A company in New Jersey called Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis, had perpetrated one of the largest frauds in modern history. Allied's business was storing commodities, primarily soybean and cottonseed oil, in massive tanks, and then using the warehouse receipts for that oil as collateral to get loans from major Wall Street banks and financial institutions. One of their biggest clients, providing the warehouse receipts that guaranteed the oil was actually in the tanks, was a subsidiary of the mighty American Express. The problem was, the oil wasn't there. DeAngelis had devised a brilliantly simple scheme. He would fill the tanks mostly with water, with only a thin layer of oil on top. When inspectors came to check, they would dip their measuring sticks in and see oil. The fraud was massive, totaling what would be over $1.5 billion in today's money. When the house of cards collapsed, Allied Crude filed for bankruptcy, and Wall Street panicked. The crucial question was, would American Express, which had guaranteed the receipts, be on the hook for the entire loss? The market's verdict was swift and brutal. American Express stock, a blue-chip darling, plunged nearly 50%. Investors, gripped by fear and uncertainty, dumped their shares indiscriminately. The narrative was that the company could be bankrupted by the scandal. Here was the ultimate test. For the average investor, this was a 5-alarm fire. The herd was stampeding for the exit. But for Warren Buffett, it was the smell of opportunity. He didn't see the panic. He saw a question that needed an answer. The entire investment thesis hinged on one thing. Would the scandal permanently impair the core, underlying businesses of American Express? He knew the company wasn't just about warehouse receipts. Its primary engines of profit were its traveler's checks and its charge card business, two businesses built on the absolute, unshakable foundation of public trust. So Buffett did what Buffett does. He didn't read analyst reports or listen to the talking heads on television. He did his own scrounging, his own primary research. He went out into the field. He visited banks and talked to tellers, asking them if they were still accepting American Express travelers' checks. They were. He went to restaurants and hotels and spoke with merchants, asking if customers were still using the American Express card. They were. He saw with his own eyes that the scandal, while a massive financial headache for the company, had not damaged the powerful moat around its core operations. Consumers and merchants still trusted the American Express brand. He concluded that the temporary loss from the salad oil fraud, while significant, was a one-time hit that the company's incredible earning power could easily absorb over time. The market was pricing the company for bankruptcy. He saw a world-class business on sale for a ridiculously cheap price. This was a punch-card moment. This was not a small, tentative bet. This was not a moment for diversification. This was the fat pitch he had been waiting for. He took 40% of his entire partnership's assets, a staggering sum that represented the life savings of everyone who trusted him, and plowed it into American Express stock. This was the epitome of extreme focus. He found one great idea, an idea he understood better than anyone else on Wall Street, and he bet the farm. It was a decision of such high conviction that it would have seemed insane to any professor of modern portfolio theory. But Buffett wasn't managing a theory. He was managing real money with the goal of achieving superior portfolio growth, not average returns. Within 2 years, the market came to its senses, the salad oil losses were contained, the core businesses continued to thrive, and the stock price more than tripled. That single, concentrated bet, that one punch on his card, cemented the fortunes of his early investors and became a foundational legend in his career. It was a masterclass in the philosophy of focus. He ignored the noise, he did the work, and he acted with decisive, overwhelming force when he knew he was right. This is the essence of the punch card worldview. You don't need 100 ideas. You need a handful of great ones, understood deeply and acted upon with conviction. The reason this strategy of extreme focus is so powerful, and yet so difficult for most people to execute, lies deep within the wiring of our brains. Our minds are not naturally built for the kind of patient, selective discipline the punch card demands. The philosophy directly counteracts several powerful cognitive biases that push the 99% of investors toward hyperactivity and mediocrity. The first and most pervasive of these is action bias. Human beings are hardwired to believe that doing something is better than doing nothing, especially in situations of uncertainty or perceived opportunity. When the market is volatile, the itch to sell is overwhelming. When a new trend emerges, the pressure to buy is immense. Sitting still, observing and deliberately choosing inaction feels counterintuitive and deeply uncomfortable. It feels like we're being lazy or missing out. The financial news media is a giant engine built to stoke this bias. Every day it screams at you to act. 5 stocks to buy now. Is it time to sell big tech? The hottest IPO of the year. This constant barrage of information creates a false sense of urgency, making investors feel that they must constantly be shuffling their portfolio management strategy to keep up. The 20-slot punch card is a direct antidote to action bias. It reframes the entire game. Inaction becomes the default setting. Action, the punching of a precious finite slot, becomes the extraordinary exception that requires an immense burden of proof. It forces you to ask, is this idea so good, so overwhelmingly compelling, that it is worth 1/20th of all the investment decisions I will ever make in my life? Suddenly the bar is raised from, is this a good idea, to, is this one of the 20 best ideas I will ever have? This simple reframing kills the impulse for casual, ill-considered action. It transforms investing from a frantic game of musical chairs into a slow, deliberate game of chess, where you might study the board for months before making a single move. The second psychological principle at play is the fight against what we might call idea collection or the intellectual Pokemon bias, the desire to have a little bit of everything. This is driven by a combination of the mere exposure effect, where we tend to develop a preference for things merely because we are familiar with them, and a misguided application of the idea of diversification. We read about dozens of companies, we hear about different sectors, and we feel smarter and safer if our portfolio reflects this broad, superficial knowledge. We own a bank stock, a tech stock, a consumer goods stock, a healthcare stock, and so on. We feel like a sophisticated connoisseur of the market. But in reality, we are a jack of all trades and a master of none. True wealth isn't built by knowing a little about a lot. It's built by knowing a lot about a little. The punch card philosophy forces you to abandon the comfort of superficial breadth and embrace the terrifying profitable power of depth. It tells you that it is infinitely better to understand one business with absolute clarity and own a meaningful stake in it, than to own small, meaningless stakes in 50 businesses you barely understand. This is a crucial distinction that separates the CEO mindset from the retail investor mindset. A CEO doesn't run 20 different businesses. They run one, and they know everything about it: its customers, its competition, its supply chain, its culture. The punch card forces you to adopt that same level of deep, focused ownership over your capital. It is a psychological device that rewires your brain to favor mastery over mediocrity, conviction over collection. It provides the structure needed for any serious journey towards financial freedom, by making focus not just a preference, but a non-negotiable rule of the game. Translating this powerful philosophy into a practical, repeatable process is where the real transformation in your asset allocation begins. It's time to build the blueprint, the applied mental model that takes the 20-slot punch card from an abstract idea to a concrete tool in your investment strategy. This is a step-by-step guide to embedding extreme focus into your financial life. Step 1 is the physical or digital creation of your punch card. Do not skip this. The act of creating the artifact is a crucial part of the psychological commitment. Take a piece of cardstock and draw 20 circles on it. Or, create a simple document or spreadsheet on your computer, titled, My 20 Life-Defining Investments. This tangible object serves as a constant, sobering reminder of the scarcity and value of your decisions. It's no longer a vague idea. It's a scoreboard that you will have to look at for the rest of your life. Every time you are tempted by a hot stock market tip or a speculative venture, you must confront the physical reality of punching out one of those precious slots. This simple ritual builds a powerful barrier against impulsivity. Step 2 is to define your circle of competence. This is perhaps the most critical exercise in all of investing. Warren Buffett famously says, "What counts for most people in investing is not how much they know, but rather how realistically they define what they don't know." You must sit down and honestly, brutally assess the industries and businesses you are capable of understanding. Your circle of competence is not what you want to know or what sounds exciting. It's what you already know through your career, your hobbies, or your deep personal study. Are you a software engineer? Your circle might include enterprise software companies. Are you a doctor? You might understand medical device companies or hospital systems far better than the average analyst. Are you a lifelong obsessive gamer? You might have a unique insight into the video game industry. Be ruthless in your honesty. Your goal is not to have the biggest circle. It is to know precisely where the borders of your circle lie, and to never, ever step outside of them. The punch card model is only effective when applied within your area of expertise. A high-conviction bet on something you don't understand isn't investing. It's just gambling with extra steps. Step 3 is to create your investment constitution, the set of non-negotiable criteria that a business must meet before it is even considered for a punch. This is your personal filter that eliminates 99.9% of all possibilities from the start. Your constitution should be written down and placed right next to your punch card. It might include rules like, I will only invest in businesses with a durable competitive advantage, or moat. Or, I will only invest in companies run by honest and able management teams with a clear track record of intelligent capital allocation. Another rule could be, I will only invest when I can buy the business at a significant discount to its intrinsic value, creating a margin of safety. These are not just guidelines, they are iron laws. A company might look cheap, but if its management is questionable, it fails the Constitution and is immediately discarded. This process forces you to move from a reactive, market-driven approach to a proactive, business-driven one. You are no longer asking, what should I buy today? You are setting an impossibly high standard and then patiently waiting for a rare candidate to come along that meets every single one of your criteria. Step 4 is the idea-to-punch workflow. When a potential candidate emerges that is within your circle of competence and appears to meet your constitution, you begin the real work. But the decision is not yet made. This is a period of deep study, where your goal is to try and kill the idea. You must actively seek out disconfirming evidence, read the bear cases, study the competitors. Imagine the 5 worst things that could happen to this business over the next 10 years. Only if the idea survives this gauntlet of negativity do you allow yourself to proceed. The final action before punching the card is to write a 1-page investment thesis. This document should clearly state, I am buying company X at price Y because of these 3 specific reasons. I believe the business is worth Z, and I expect these catalysts to unlock that value over the next 5 years. The biggest risks are A, B, and C, and I am willing to accept them because of D, E, and F. This document is your proof of work. It is the final checkpoint that ensures you are acting on rigorous analysis, not emotion. Only then, with clarity and conviction, do you pick up your puncher and make that irreversible mark on your card. This structured process transforms you from a passive market participant into a disciplined, professional capital allocator, a true practitioner of high-conviction investing. To fully appreciate the wisdom of this focused approach, we must shine a harsh light on its opposite, the path walked by the 99% of investors, a path of frantic activity, superficial knowledge, and guaranteed mediocrity. This is the antithesis, the world of the over-diversified, and it is a cautionary tale of how good intentions can lead to disastrous financial outcomes. The typical retail investor portfolio is not a portfolio at all. It is a chaotic museum of past hopes and fears. It often contains 50, 60, even 100 different positions. There's a sliver of the tech giant they bought at its peak. There's a few shares of a speculative mining company their brother-in-law recommended. There's an ETF for emerging markets they read about in a magazine. There's the remnants of an IPO they got excited about for a week. They call this diversification. Buffett calls it diversification. This individual is not an investor. They are a stock collector. They know the ticker symbols of everything they own, but they couldn't tell you who the CEO is, what the company's competitive advantage is, or how it generates cash. They have mistaken being busy for being productive. Their portfolio management strategy is driven by headlines and whims. This approach is not just suboptimal, it is mathematically destined for failure for several key reasons. First, it eliminates any chance of life-changing returns. Let's say by pure luck, one of your 100 stocks turns out to be a 10-bagger. It increases in value by 1,000%. If that stock was only 1% of your portfolio, this spectacular success increases your total net worth by a mere 10%. Your life doesn't change. The impact of your single best idea is diluted into insignificance by the dead weight of the other 99 mediocre holdings. A concentrated investor holding that same company as a 20% position would have more than doubled their entire portfolio from that single decision. That is the kind of portfolio growth that leads to real financial freedom. The collector has diversified away their single greatest asset, the potential for their best ideas to make a real difference. Second, it creates an illusion of safety that masks underlying ignorance. The collector feels safe because their risk is spread out. But risk is not the same as volatility. The true risk in investing is not that a stock price goes down temporarily. The true risk is the permanent loss of capital, which happens when you invest in a bad business or overpay for a good one. Because the collector doesn't have the time or incentive to deeply understand any of their 100 holdings, the odds that they have unknowingly bought several terrible businesses or overpaid for many others are extremely high. Their perceived safety is a mirage. The focused investor with only 5 to 10 holdings understands each business intimately. They have done the work to establish a margin of safety. They may experience more short-term price volatility, but their risk of permanent capital loss is often far, far lower. They have substituted the false safety of diversification for the true safety of knowledge. Finally, the path of the 99% is a paradise for Wall Street and a nightmare for the investor's wallet. This hyperactive churning of dozens of positions generates a constant stream of trading commissions, fees, and most damagingly, taxes. Every time a small position is sold for a modest gain, a taxable event is triggered, siphoning away capital that could have been compounding. The punch card investor, by contrast, is a tax manager's dream. Their holding periods are measured in years, often decades, allowing their capital gains to compound tax-deferred for enormous stretches of time. They think like a business owner, not a trader, and this long-term perspective is a massive and often overlooked financial advantage. The path of the 99% is a treadmill of activity that leads nowhere. It's a strategy designed to make you feel like you're participating in the market, while ensuring you never truly benefit from its wealth-creating power. It is the direct result of ignoring the philosophy of extreme focus, and it is the single biggest reason why most people fail to achieve their long-term financial goals. The financial connection between the philosophy of extreme focus and tangible wealth creation is not abstract, it is direct, mathematical, and profound. Adopting the 20-slot punch card model fundamentally alters the arithmetic of your portfolio, transforming it from a sluggish index hugger into a high-powered engine for capital gains. Let's quantify this impact. Imagine two retail investors, Investor A, the collector, and Investor B, the focuser. Both start with a $100,000 portfolio. Investor A, following the conventional wisdom of diversification, buys 50 stocks, allocating 2% of their portfolio, or $2,000 to each. They do some light research, picking companies that seem good. Investor B, using the punch card model, spends 6 months doing deep research and identifies just 5 outstanding businesses. They allocate 20% of their portfolio, or $20,000, to each of these high-conviction ideas. Now let's fast forward 5 years. In Investor A's portfolio, some stocks have done well, some have done poorly, and most have been average. By sheer luck, one of their 50 stocks, Company X, turns out to be a spectacular winner, a 5-bagger that increases 400%. Their initial $2,000 investment is now worth $10,000, a gain of $8,000. However, another of their stocks went bankrupt, losing the full $2,000. 10 others lost 50% of their value for a combined loss of $10,000. The other 38 stocks, on average, tracked the market, gaining about 50%, turning $76,000 into $114,000. Their total portfolio value is now $10,000, the winner, plus $0, the loser, plus $10,000, the 10 losers, plus $114,000, the average ones, for a total of $134,000. After 5 years, they have achieved a modest return, barely beating inflation after taxes and fees are accounted for. Now consider Investor B, the focuser. Let's assume their skill in stock picking is no better than Investor A's luck. They also picked that same winning Company X. But for them, it was a 20% position. Their initial $20,000 investment, with a 400% gain, is now worth $100,000. Let's say one of their 5 picks was also a complete disaster and went to zero, a $20,000 loss. Their other 3 picks were just average market performers, gaining 50% on their combined $60,000 investment, turning it into $90,000. Investor B's total portfolio is now worth $100,000, the winner, plus $0, the loser, plus $90,000, the average ones, for a total of $210,000. By simply concentrating their capital into their best ideas, Investor B achieved a return that utterly dwarfs Investor A's, even with the same win-loss record. The winner had a meaningful impact, and the portfolio growth was explosive. This is the raw mathematics of a concentrated portfolio. It amplifies the impact of your correct decisions. This direct financial connection goes even deeper when you consider the concept of opportunity cost. Every dollar you invest in your 50th best idea is a dollar you cannot invest in your absolute best idea. The collector is constantly diverting capital away from their potential champions and into a sea of mediocrity. The focuser ensures that every single dollar of their capital is working for them in the highest return opportunity they can find. This is a CEO mindset applied to personal wealth management. A CEO doesn't allocate capital equally to all projects. They starve the bad projects and pour resources into the ones with the highest potential return on investment. The punch card forces you to manage your personal capital with that same professional rigor. Finally, this philosophy has a direct and massive impact on your balance sheet through the reduction of frictional costs. The collector, constantly trading in and out of their dozens of positions, is in a constant battle against taxes and commissions. A 20% gain can easily be reduced to a 15% net gain after short-term capital gains taxes. The focuser, who makes a decision and holds for a decade, allows their wealth to compound in a tax-efficient manner. When they finally do sell, their gains are taxed at the much lower long-term capital gains rate. Over a lifetime of investing, This difference in tax efficiency alone can amount to hundreds of thousands or even millions of dollars. The 20-slot punch card is not just a psychological trick. It is a strategic financial system designed to maximize the mathematical forces of compounding and conviction, while minimizing the destructive forces of fees, taxes, and mediocrity. It is the blueprint for taking an average sum of money and, through discipline and focus, turning it into a life-altering fortune. The first pillar, the philosophy of extreme focus, sets the stage. But the second pillar is where the real work begins, where fortunes are protected and mediocrity is held at bay. This is the discipline of no, the active, often painful practice of mastering in action. If the punch card represents your 20 yeses, then your success is ultimately defined by the thousands of no's that protect them. Most investors believe the key to beating the market is finding the next big winner. They are constantly on the hunt, screening stocks, reading news, searching for that one magic bullet. Buffett understands a more profound truth. The key to exceptional long-term returns is not finding the winners, but ruthlessly avoiding the losers, and, even more importantly, avoiding the merely good. And the most legendary example of his mastery of no was his stoic, and at the time widely ridiculed, refusal to participate in the dot-com bubble of the late 1990s. The scene is the late 1990s. The internet is changing the world, and a new paradigm of investing has taken hold. Technology stocks are soaring to astronomical valuations. Companies with no profits, no revenues, and sometimes no finished product are going public and seeing their stock prices double or triple overnight. It was a gold rush. Financial news networks ran 24/7 coverage of the frenzy. Taxi drivers were giving stock market tips. It seemed that anyone who wasn't invested in tech was a fool, a dinosaur destined to be left behind. And sitting in Omaha, Nebraska, was the most famous investor in the world, Warren Buffett, doing nothing, absolutely nothing. Berkshire Hathaway was sitting on tens of billions of dollars in cash, a veritable mountain of dry powder. And as the NASDAQ Composite Index rocketed past 2,000, then 3,000, then 4,000, Buffett refused to invest it in the technology sector. The criticism was relentless. Magazine covers declared him washed up, a relic of an old economy who just didn't get it. Barron's ran a cover story in 1999 titled "Warren, What's Wrong?" Pundits and analysts openly mocked him, arguing that his value investing principles were obsolete in this new, fast-paced technological age. The pressure to conform, to join the party, was immense. His own shareholders were growing restless, watching their neighbors get rich on stocks like Pets.com, while Berkshire's stock price actually declined in 1999. This was not just a financial test, it was a profound psychological trial. Imagine the discipline it took. Every day, for years, turning on the television and seeing people with a fraction of your intellect and experience making fortunes in an area you have publicly decided to avoid. It requires an almost superhuman ability to divorce your ego from your investment process. But Buffett's no was not born of ignorance or stubbornness, it was born of discipline. His reasoning was simple and unwavering, rooted in the core tenets of his investment philosophy. He was operating within his circle of competence. As he famously said, "If I don't understand it, I don't invest in it." He couldn't reliably project the cash flows of these new tech companies 10 or 20 years into the future. He couldn't identify a durable competitive advantage, a moat, in a landscape where technology was changing by the week. He saw hundreds of companies competing in the same space and, as he put it, he knew that while the internet would change the world, it was nearly impossible to pick the handful of long-term winners from the hundreds of competitors destined for bankruptcy. So he said no. He refused to punch his card for a game he didn't understand, no matter how exciting or popular that game became. He chose the certainty of his own process over the allure of easy speculative gains. And then, in March of 2000, the bubble burst. The NASDAQ, which had peaked above 5,000, began a catastrophic collapse. Over the next 2 years, it would lose nearly 80% of its value. Trillions of dollars of speculative wealth evaporated. The companies that had been heralded as the future went bankrupt. The pundits who had mocked Buffett fell silent, and Warren Buffett, with his mountain of cash, was there to pick up the pieces, buying wonderful businesses at bargain prices from the very people who had been forced to sell in the panic. His disciplined no during the boom years was the very thing that enabled his hugely profitable yes in the aftermath. This story is the ultimate testament to the power of inaction. It teaches us that true investment discipline isn't about the courage to buy, it's about the fortitude to say no over and over again, until an opportunity arises that is so good, so clear, and so within your expertise that the answer is an unequivocal yes. Your punch card is a shield, and its primary function is to deflect the thousands of tempting, but ultimately mediocre or unknowable, ideas that threaten to dilute your capital and your focus. The immense difficulty of saying no, especially when everyone around you is screaming yes, is a battle fought on the battlefield of the mind. The discipline of inaction requires a conscious and deliberate war against some of the most powerful and primitive psychological biases that govern human behavior. The first and most formidable enemy is FOMO, the fear of missing out. This is not just a catchy acronym for millennials, it is a deep-seated evolutionary impulse. For our ancestors, being excluded from the group, missing out on a new food source, or failing to participate in a collective hunt could mean death. This fear of being left behind is wired into our social DNA. The stock market is a modern-day arena where this bias runs rampant. When a stock or a sector is soaring and stories of overnight millionaires fill the air, FOMO triggers a powerful, visceral panic. The logical parts of our brain shut down, and the emotional, impulsive parts take over. We feel an overwhelming urge to join the herd, not because of a rational analysis of the investment's merit, but simply because we cannot bear the psychological pain of watching others get rich without us. The dot-com bubble was a perfect storm of FOMO. Saying no in that environment was an act of profound psychological rebellion. It required overriding a primal instinct. The 20-slot punch card serves as a powerful psychological circuit breaker against FOMO. It forces a moment of pause and rationality. The question is no longer, am I missing out? The question becomes, is the pain of potentially missing this one run-up greater than the pain of permanently expending one of my 20 lifetime opportunities on a speculative bet I don't fully understand? This reframing changes the emotional calculus. It pits the short-term, acute pain of FOMO against the long-term, permanent pain of a wasted punch. For a disciplined investor, the choice becomes clear. Closely related to FOMO is herd mentality, also known as social proof. This is the cognitive bias, where we assume that the actions of others reflect the correct behavior for a given situation. If everyone is running out of a building, you don't stop to analyze the situation. You run too. In the market, this translates to, if everyone is buying tech stocks, they must know something I don't. This bias is particularly dangerous because it feels rational. It's a mental shortcut that allows us to outsource our thinking to the collective. But in investing, the collective is often wrong, especially at the extremes. As Buffett famously said, be fearful when others are greedy, and greedy when others are fearful. This is a direct command to fight against herd mentality. The punch card is an act of intellectual sovereignty. It declares that you will not outsource your thinking. Each punch must be earned through your own independent work and analysis. It doesn't matter if 1 million people are buying a stock. If it doesn't meet your time-ter criteria, if it's outside your time-ter circle of competence, the answer is no. It forces you to build your conviction from the inside out, based on facts and analysis, rather than from the outside in, based on popularity and momentum. This is the foundation of a durable and successful investment strategy, one that can withstand the psychological storms of market euphoria and panic. Mastering the discipline of no is ultimately about cultivating an internal locus of control, believing that your outcomes are a result of your own decisions, not the whims of the crowd. It's about developing the quiet confidence to sit patiently on the sidelines, armed with your punch card and your principles, waiting for the truly exceptional pitch, while the rest of the world swings wildly at everything. To operationalize the discipline of no, you need more than just willpower. You need a systematic process, a blueprint for rejecting ideas efficiently and effectively, so that your mental energy is conserved for analyzing the few that truly deserve it. This is how you build a fortress around your 20 precious slots. Step 1 is to build an anti-portfolio watch list. Most investors keep a watch list of stocks they want to buy. You will do the opposite. You will create a list of popular, hyped up, or tempting stocks that you have explicitly decided not to invest in. For each stock on this list, you will write down 1 or 2 sentences explaining exactly why you are saying no. For example, XYZ Tech Corp saying no because its valuation assumes flawless execution for the next 10 years, leaving no margin of safety. Or ABC Retail saying no because it operates outside my circle of competence. I do not have a deep understanding of fashion trends. This practice does 2 things. First, it forces you to articulate your reasoning, turning a vague feeling of unease into a concrete, rational decision. Second, it serves as a powerful learning tool. You can revisit your anti-portfolio a year later and see if your reasoning for saying no was sound. This builds confidence in your decision-making framework and helps you refine your criteria over time. It's a training ground for your investment judgment. Step 2 is to implement an investment pre-mortem. This technique, borrowed from the world of project management and executive decision-making, is incredibly powerful. Before you even begin to research the positive aspects of a potential investment, you force yourself to argue against it. You convene a council of doom in your own mind. Imagine it is 1 year after you have invested in this company, and the investment has been a complete disaster. The stock is down 50%. Now write the story of why it failed. Was it a new competitor, a change in technology, a management misstep, an economic downturn that disproportionately affected the industry? By forcing yourself to articulate the pathways to failure before you get emotionally invested in the idea, you can identify key risks and weaknesses with a much clearer head. Often, this exercise alone will be enough to show you that the idea is not worth a punch. You have killed the idea before it has a chance to mesmerize you with its potential upside. This is a direct countermeasure to confirmation bias, the tendency to seek out information that supports our pre-existing beliefs. The pre-mortem forces you to start with the bear case, building a more balanced and realistic assessment. Step 3 is to enforce a mandatory waiting period. The financial world moves at lightning speed, and this creates a sense of urgency that leads to bad decisions. To combat this, create a personal rule. You will never make an investment decision on the same day you get the idea. Institute a mandatory cooling-off period of at least 1 week or even 1 month for major decisions. This simple rule diffuses the emotional intensity of FOMO and allows your rational brain to come back online. An idea that seems brilliant and urgent in the heat of the moment often looks much less compelling after a week of calm reflection. If the opportunity is truly great, it will still be there after your waiting period. As the saying goes in investing, the market is a no-called strike game. You can stand at the plate and watch thousands of pitches go by, good, bad, and mediocre, and you are never penalized for not swinging. You only get a strike when you swing and miss. The waiting period is your way of ensuring you only swing at the pitches that are right down the middle of the plate, the ones you are supremely confident you can hit out of the park. By combining an anti-portfolio, a pre-mortem process, and a mandatory waiting period, you build a multi-layered defense system. This is the practical blueprint for mastering the art of inaction, the core skill required for any successful practitioner of high-conviction investing. It's how you ensure that when you finally do decide to punch your card, the decision is the result of discipline, not impulse. The consequences of failing to cultivate this discipline of no are stark and unforgiving. The path of the 99%, the path of the hyperactive yes-man investor, is a road paved with high fees, crippling taxes, and the agonizing regret of missed opportunities. It is the antithesis of the calm, deliberate wealth building of the punch card philosophy. The most common archetype on this path is the hot tip chaser. This individual's investment strategy is entirely outsourced to external noise. They buy a stock because they saw a charismatic guru on TV recommend it. They sell a stock because a scary headline predicted a market crash. They jump into a speculative biotech because their cousin heard a rumor at a party. Their portfolio is in a constant state of flux, churning based on the whims of the day. They have no core philosophy, no circle of competence, no personal constitution. They are a leaf in the wind of market sentiment. This approach is financially ruinous. Each trade incurs a commission, slowly bleeding the portfolio. Worse, they are almost always buying high, in a frenzy of excitement, and selling low, in a fit of panic. They are the person who bought technology stocks in late 1999 and sold them in 2001, crystallizing massive losses. They are the perfect counterparty for the disciplined, patient investor who is happy to sell to them at the top and buy from them at the bottom. The hot tip chaser's journey is one of constant motion but no forward progress, a frantic dance that enriches their broker but leaves them poorer. Another common failure mode is the compulsive tinkerer. This person is more sophisticated than the tip chaser. They read the financial news, they understand basic valuation metrics, and they have a portfolio. But they can't leave it alone. They are addicted to the feeling of action. They might sell a great company they own to buy another that they think is slightly cheaper. They trim a position after a small run-up to lock in profits. They are constantly trying to optimize, to micromanage their way to better returns. This behavior is a classic example of action bias leading to wealth destruction. Often the best course of action with a truly wonderful business is to do nothing, to let the miracle of compounding work its magic over years and decades. By constantly tinkering, this investor interrupts compounding. They sell their winners too early, preventing them from growing into the life-changing positions they could have been. And they are constantly triggering taxable events. That small gain they locked in comes with a tax bill, reducing the capital they have available to reinvest. They are like a gardener who keeps pulling up his carrots to see if they are growing. Their incessant activity prevents any real, long-term portfolio growth from taking root. Finally, there is the fearful dabbler. This person understands the value of investing but is terrified of making a mistake. So they say yes, but only in the smallest, most timid way possible. They might buy $100 worth of a stock they believe in. This is not investing. It is buying a lottery ticket. It's a way to participate in the market without any real skin in the game. It's the financial equivalent of dipping a toe in the water instead of learning to swim. While they avoid large losses, they also completely eliminate the possibility of significant gains. Even if their analysis is brilliant and they pick the next great company, their tiny position size means the victory is hollow. Their net worth remains unchanged. This is a failure of conviction, a direct consequence of not having a framework like the punch card that forces you to distinguish between casual interests and true investment commitments. All these paths, the chaser, the tinkerer, and the dabbler, stem from a failure to master the discipline of no. They are all forms of undisciplined yeses, yes to tips, yes to tinkering, yes to timid bets, and they all lead to the same destination. A portfolio that reflects a history of impulsive actions rather than a future of financial freedom. The direct financial connection between mastering the discipline of no and building wealth is profound and multifaceted. It manifests on your balance sheet in three critical ways: cost reduction, tax optimization, and the preservation of psychological capital. First, let's quantify the direct impact of cost reduction. The average retail investor who actively trades, driven by tips and a need for action, can easily rack up significant trading commissions. While many brokers now offer zero-commission trades on stocks, this is a recent phenomenon and doesn't apply to all assets. But the more significant cost is the bid-ask spread. Every time you buy or sell, you cross this spread, effectively paying a small toll to the market makers. For an active trader churning a $100,000 portfolio, these spreads and fees can easily add up to 1% or 2% of the portfolio's value per year. That's $1,000 to $2,000 that vanishes before you even consider the performance of your investments. It's a guaranteed annual headwind. A punch card investor who might make one trade every 2 or 3 years reduces this frictional cost to virtually zero. That 1% to 2% per year stays in their account, compounding alongside their capital. Over a 30-year investment horizon, that seemingly small difference can amount to a 6-figure sum. The second area is tax optimization, and its impact is even more dramatic. In the United States, gains on investments held for less than a year are typically taxed as short-term capital gains, at your ordinary income tax rate. This can be as high as 37% at the federal level, plus state taxes. Gains on investments held for more than a year are taxed at the much lower long-term capital gains rates, which are typically 0%, 15%, or 20%. The undisciplined investor who is constantly churning their portfolio is a walking tax generation machine. Let's say they make a $10,000 profit on a trade held for 6 months. If they are in a 24% federal tax bracket, they immediately owe $2,400 to the IRS, leaving them with only $7,600 to reinvest. A punch card investor, holding a great business for a decade, allows that same $10,000 profit to grow and compound for 9 more years before times any taxes paid. And when they do finally sell, it's taxed at the 15% long-term rate, meaning they owe only $1,500. The difference is not just the lower rate, it's the 9 extra years of tax-deferred compounding on the government's money. This is a massive structural advantage. The discipline of no is, in effect, one of the most powerful tax avoidance strategies available to the individual investor. It transforms your portfolio from a tax-inefficient trading account into a tax-efficient compounding machine. Finally, there's the preservation of a finite resource that never appears on a balance sheet but is critical to success: psychological capital. Every decision you make, especially under pressure, drains your mental energy. The hyperactive investor is in a constant state of low-grade anxiety. They are checking prices, worrying about headlines, and second-guessing their decisions. This leads to decision fatigue, a state where the sheer number of choices you've made degrades the quality of subsequent choices. By saying no by default, the punch card investor conserves their precious psychological capital. They are not distracted by the daily noise. They are calm, rested, and focused. When one of their rare, high-conviction opportunities finally appears, they have the full measure of their mental and emotional resources available to analyze it clearly and act decisively. They avoid the burnout and emotional exhaustion that plagues the 99%. This is an unquantifiable but immensely valuable advantage. By saying no to the trivial many, you preserve your financial, fiscal, and psychological capacity to say a definitive, life-changing yes to the vital few. That is the direct, tangible, and fortress-building financial power of inaction. We have established the worldview of extreme focus and the critical discipline of saying no. Now we arrive at the third pillar, the engine room of the entire punch card philosophy, the due diligence mandate. This is the immense, often grueling work required to earn the right to punch one of your 20 slots. For the average investor, research might mean looking up a stock's price chart, reading a single analyst report, or scanning the company's homepage. For a punch card investor, that is merely the first sentence of the first chapter of a very long book. If a decision is meant to last a decade or more and involves a significant portion of your net worth, the level of preparatory work must be correspondingly immense. The goal is not just to understand the business. It is to know it so well that you would be comfortable owning the entire company outright. There is no better illustration of this obsessive level of diligence than Buffett and Munger's acquisition of See's Candies in 1972. This transaction, though relatively small at the time, was a pivotal moment for Berkshire Hathaway, and it perfectly showcases the deep, qualitative work that underpins a high-conviction bet. On the surface, See's Candies looked like a decent but unremarkable business. It was a well-established chain of candy shops on the West Coast. The numbers were okay. It earned a respectable but not spectacular return on its tangible assets. For a typical financial analyst, it would have been an easy pass. It wasn't a fast-growing tech company. It was just selling chocolates. But Buffett and Munger didn't just look at the numbers. They dug deeper, seeking to understand the intangible asset that didn't appear on the balance sheet: the brand. They began their due diligence by becoming customers and observers. They visited the stores. They saw the long lines at Christmas and Valentine's Day. They tasted the product and recognized its quality. But their real insight came from understanding the psychology of the customer. They realized that people weren't just buying chocolate, they were buying nostalgia, tradition, and a guarantee of quality. A man buying a box of See's for his sweetheart wasn't going to risk switching to a cheaper, unknown brand to save a couple of dollars. The gift was a gesture, and the trusted See's name was a crucial part of that gesture's value. This gave the company incredible pricing power. Buffett understood that See's could raise its prices every year, year after year, without losing customers. The small increase would be more than offset by inflation and the emotional value of the brand. This pricing power was a hidden gold mine, a durable competitive advantage that the cold numbers on a spreadsheet failed to capture. Their diligence went further. They spoke with former employees and managers. They studied the history of the See family and the culture of quality they had instilled. They analyzed the company's simple, efficient business model. It received cash up front from customers and paid its suppliers later, creating a negative working capital cycle, or float, that essentially meant customers were financing the company's operations for free. They weren't just analyzing a stock. They were performing a deep, forensic analysis of a living, breathing business. The sellers were asking for $30 million, but Buffett's initial calculation based on tangible assets valued the company at closer to $25 million. A younger Buffett, a stricter cigar-butt value investor, would have walked away. But this deep due diligence had taught him a powerful lesson. Largely at the urging of Charlie Munger, they realized that paying a fair price for a truly wonderful business with a durable moat and pricing power was a far better strategy than buying a mediocre business at a bargain price. They had earned the right to punch the card not just by running the numbers, but by understanding the soul of the company. They paid the $25 million they were initially comfortable with, which was their revised offer after some haggling. Since that purchase in 1972, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring minimal additional capital investment. It became the prototype for the kind of high-quality, cash-generative businesses Buffett would seek for the rest of his career. This story is the perfect embodiment of the due diligence mandate. It's a testament to going beyond the financial statements and understanding the qualitative factors, the brand, the customer behavior, the culture, the competitive landscape, that truly determine a company's long-term success. This is the level of work required when you only have 20 slots. You must become a true business analyst, not a mere market analyst. The obsessive due diligence mandated by the punch card philosophy is not just a good habit, it is a powerful weapon against the cognitive biases that lead to investment ruin. It is a systematic process for de-risking a decision by replacing ignorance and speculation with deep, factual knowledge. The primary psychological enemy it vanquishes is the Dunning-Kruger effect. This is the cognitive bias whereby people with low ability at a task overestimate their ability. In investing, this is rampant. An investor reads a couple of articles, looks at a PE ratio, and concludes they are an expert on a company. They mistake a sliver of information for a comprehensive understanding. This overconfidence leads them to make bets without a true appreciation of the risks involved. The sheer workload demanded by the punch card due diligence process is a powerful antidote to this. It is a humbling experience. As you start digging into a company's regulatory filings, its competitive landscape, and its supply chain, you are immediately confronted with the vastness of what you don't know. The process forces humility. It compels you to acknowledge the complexity of the business world and to respect the difficulty of predicting the future. You cannot maintain an illusion of expertise when you are spending 40 hours studying the minutiae of a single company. This process ensures that by the time you are ready to make a decision, your confidence is rooted in genuine, hard-won competence, not in ignorant over-optimism. It aligns your perceived knowledge with your actual knowledge. The second critical bias that this process dismantles is confirmation bias. As we've discussed, this is our natural tendency to search for, interpret, favor, and recall information in a way that confirms our pre-existing beliefs or hypotheses. Once an investor decides they like a stock, they will subconsciously start looking for reasons to justify that decision. They'll click on the bullish analyst reports and dismiss the bearish ones. They'll focus on the company's strengths and downplay its weaknesses. This creates a dangerous echo chamber that reinforces their initial impulse, regardless of its validity. A rigorous due diligence framework, like the one we will outline, must be intentionally designed to fight this. It forces you to actively seek out disconfirming evidence. Part of the process must be to build the strongest possible case against the investment. You must put on the hat of a skeptical short seller and try to destroy your own best idea. What are the most powerful arguments the bears are making? Are they valid? What could go wrong? What are the hidden risks? By making this search for negative information a mandatory part of your checklist, you short-circuit the brain's natural tendency towards self-confirmation. This intellectual honesty is the hallmark of a professional approach to risk management. It ensures that your final decision is not the result of a one-sided love affair with an idea, but a balanced judgment that has weighed both the potential rewards and the full spectrum of potential risks. By systematically counteracting both the Dunning-Kruger effect and confirmation bias, the due diligence mandate transforms investing from an act of faith into an act of reason. It is the intellectual scaffolding that supports high-conviction bets, allowing you to invest significant capital not because you are a reckless gambler, but because you have done the work to tilt the odds decisively in your favor. Now let's build the blueprint for this level of deep, business-focused analysis. This is a practical, step-by-step mental model for earning the right to punch your card. This isn't just a checklist. It's a comprehensive research framework designed to take you from a casual observer to a genuine expert on a business. It can be broken down into 4 main areas: the business, the management, the financials, and the valuation. Part 1. Understanding the business. This is the qualitative heart of the analysis. You must be able to answer these questions in simple, clear language. First, how does this company make money? Describe its business model as if you were explaining it to a child. If you can't, you don't understand it well enough. Second, what is its durable competitive advantage, or moat? Is it a powerful brand like Coca-Cola? Is it a network effect like Facebook or Visa? Is it a low-cost production advantage like Geico? Is it high switching costs, like the software your company uses? Or is it a government-granted patent? You must be able to clearly identify and articulate the source of the company's long-term competitive strength. A business without a moat is not a suitable candidate for a punch card investment. Third, who are its customers, and why do they choose this company? What is the value proposition? Fourth, who are its main competitors, and what are their strengths and weaknesses? How likely is it that a new competitor could disrupt this industry in the next 10 years? This requires deep industry research, not just company research. You should read the annual reports of the competitors, as well as your target company. Part 2. Assessing the management. You are not just buying a collection of assets, you are partnering with the people who run the business. This is a critical and often overlooked part of due diligence. First, Is the management team honest and transparent? Read the last 10 years of the CEO's letters to shareholders in the annual reports. Do they speak candidly about both successes and failures? Or is it all corporate jargon and self-congratulation? Buffett says he looks for 3 things in a manager: integrity, intelligence, and energy. And if they don't have the first, the other 2 will kill you. Second, is the management team rational in its capital allocation? This is the CEO's most important job. Look at their track record. When the company has had excess cash, what did they do with it? Did they make smart, synergistic acquisitions? Did they buy back stock when it was undervalued? Or did they squander it on overpriced empire-building acquisitions or ill-timed share repurchases at the top of the market? This analysis separates the truly great executive decision-making from the merely average. A management team with a history of destroying shareholder value is an immediate disqualifier, no matter how good the underlying business is. Part 3. Analyzing the financials. Now that you understand the business and its leadership, you can look at the numbers to see if the story they tell matches the reality. This is not about complex financial modeling. It's about understanding key trends and indicators of health. Look at a 10-year history of the financial statements. Are revenues and earnings consistently growing? What are the profit margins, and are they stable or expanding? This indicates the presence of a moat and pricing power. Most importantly, focus on return on invested capital, ROIC. This metric tells you how efficiently the company is using its money to generate profits. A company that can consistently generate a high ROIC is a compounding machine. Finally, look at the balance sheet. How much debt does the company have? A company with a pristine balance sheet can weather any economic storm, while a highly leveraged one is fragile. Part 4. Determining the valuation. Only after you have completed all the above steps can you begin to think about price. The goal is to calculate a conservative estimate of the company's intrinsic value, what it's truly worth as a business. There are many ways to do this, but a simple approach is a discounted cash flow, DCF analysis, where you project the company's future cash flows and discount them back to the present day. The key is to be conservative in your assumptions. Once you have a range for intrinsic value, you compare it to the current market price. The final step is to demand a margin of safety. You will only punch your card if you can buy the business at a significant discount to your conservative estimate of its value. If you believe a business is worth $100 per share, you might set your buy price at $60 or $70. This discount is your protection against being wrong. It's the cushion that ensures that even if your analysis is slightly off, you are unlikely to suffer a permanent loss of capital. This 4-part framework is not easy. It takes time, effort, and intellectual honesty. But it is the necessary work. It is the process that builds unshakable conviction and earns you the right to make a concentrated bet. It is the blueprint for turning a punch card slot from a gamble into a calculated, high-probability investment. The antithesis of this rigorous due diligence is the path of the 99%, the domain of the surface-level analyst. This individual believes they are doing research, but in reality, they are merely collecting superficial data points. Their process is a caricature of true analysis, and it provides a dangerous illusion of knowledge that often leads to catastrophic investment decisions. The surface-level analyst's journey begins with a stock screener. They set a few simple criteria: a low P/E ratio, a high dividend yield, a price below its 52-week high. A list of companies pops up, and they begin their research. This consists of glancing at the summary page on a financial website. They see the P/E is 12 and think, "This is cheap." They see the dividend yield is 4% and think, "I get paid to wait." They look at the one-year price chart and see it's down 30% and think, "It's due for a rebound." This entire process might take 5 minutes. They have mistaken a handful of data points for genuine insight. They haven't asked times why times the P/E is low. Perhaps it's low because the company's core product is becoming obsolete and its earnings are about to collapse. That isn't a cheap stock. It's a value trap. They haven't asked why the dividend is high. Perhaps the company is borrowing money to pay it, and the dividend is unsustainable and about to be cut, which will cause the stock to plummet. They haven't asked called the stock is down 30%. Perhaps it's down because a major new competitor has entered the market and is eating their lunch. The surface-level analyst confuses statistics with a story. They see the what, but never investigate the why. They are like a doctor who diagnoses a patient based only on their temperature, without asking about any other symptoms. This approach is lazy, but it's also psychologically comforting. It provides a veneer of rationality for what is essentially an impulsive decision. It allows the investor to feel smart and analytical without doing any of the hard, time-consuming work of actually analyzing a business. Another hallmark of the surface-level analyst is an obsession with narratives and buzzwords over fundamentals. They will buy a company because it is involved in artificial intelligence, the metaverse, or clean energy, without any deep understanding of how the company will actually monetize these trends. They are buying a story, not a business. The narrative sounds compelling, so they assume the investment must be good. This makes them incredibly vulnerable to hype cycles and bubbles. They are the investors who pile into a sector at the peak of its popularity, only to be left holding the bag when the narrative changes and the hype subsides. They lack the deep, fundamental understanding of the business that would allow them to hold on through periods of volatility or to recognize when the underlying story is no longer true. The disastrous consequence of this superficial approach is that the investor has no real conviction. Because their research was a mile wide and an inch deep, their belief in the investment is fragile. At the first sign of trouble, a bad quarterly report, a negative news headline, a market downturn, they panic and sell. They have no deep well of knowledge to draw upon to give them the confidence to hold on. Their decision to buy was based on flimsy evidence, so their decision to sell is equally impulsive. This cycle of shallow research leading to weak conviction and panicked selling is a primary driver of underperformance for the 99%. It is the direct result of failing the due diligence mandate, of trying to get the reward of a punch card investment without paying the price of the required work. The financial connection between obsessive due diligence and superior returns is one of the most powerful and direct links in the entire investment process. It is the mechanism by which knowledge is transmuted into money. It all comes down to one core concept: creating a knowledge arbitrage or an informational edge. The stock market in the short term is a voting machine, driven by emotions, narratives, and popularity contests. But in the long term, it is a weighing machine, driven by the underlying fundamentals of businesses, their earnings, their cash flows, and their competitive advantages. The goal of deep due diligence is to understand the weight of a business far more accurately than the votes of the market currently reflect. When you do the level of work we've described, you develop a proprietary view of a company's value. This is your informational edge. Let's quantify this. Imagine a company whose stock is trading at $50 per share. The surface-level analyst, and thus the majority of the market, sees a company with slowing revenue growth and some negative headlines. Their shallow analysis leads them to believe the company is in trouble, and they either sell or avoid it. You, the deep-diving analyst, spend 50 hours researching the company. You discover that the slowing revenue is due to a temporary, cyclical downturn in their industry, which happens every 5 years. You read the technical manuals for their new product and realize it is a game changer that competitors cannot easily replicate. You analyze the management's capital allocation and see they have been intelligently using the downturn to buy back their own undervalued stock. Your deep research allows you to conservatively estimate that the intrinsic value of the business is actually $100 per share. The market is offering you a dollar bill for 50 cents. This gap between the market price, $50, and your well-researched estimate of intrinsic value, $100, is your margin of safety. This is a direct, quantifiable financial advantage. When you punch your card and buy the stock at $50, you are not speculating. You are making a calculated investment with a built-in buffer against error. Over the next 2 to 3 years, as the industry cycle turns up and the new product gains traction, the company's earnings will re-accelerate. The market, which is slow to recognize these fundamental shifts, will eventually catch on. The votes will start to align with the weight. The stock price will gravitate towards its intrinsic value of $100 per share, doubling your money. Your profit was not the result of luck or market timing. It was the direct financial harvest of the due diligence you sowed. You made money because you knew something the market didn't fully appreciate yet. This is the essence of beating the market. Furthermore, this deep knowledge has a direct impact on your ability to manage risk and maximize capital gains. When a market panic occurs and the stock you bought at $50 drops to $30, the surface-level analyst who owns it will panic and sell, crystallizing a 40% loss. They have no foundation of knowledge to support their conviction. You, on the other hand, will review your detailed research notes. You will confirm that the business fundamentals have not changed. You will see the panic as an even greater opportunity, a chance to buy a dollar bill for 30 cents. You may even decide to punch a second, smaller slot, adding to your position at an even more attractive price. Your due diligence transforms a moment of terrifying risk into a moment of outstanding opportunity. It allows you to act rationally when others are acting emotionally, a behavior that is the very cornerstone of building long-term wealth. The hours you spend in the library, poring over annual reports, are directly converted into a financial advantage that manifests as a lower purchase price, a wider margin of safety, and the psychological fortitude to not just survive, but to profit from market volatility. That is the undeniable financial power of earning your punch. Pillars 1 through 3, focus, discipline, and diligence, are the essential groundwork. They are the meticulous process of identifying a truly extraordinary opportunity. But identifying the opportunity is not enough. The fourth pillar is where potential energy is converted into kinetic energy. It is the conviction to concentrate, the raw courage to bet big when you know the odds are overwhelmingly in your favor. Having done the work, having earned the right, you must now act with a level of decisiveness that is completely foreign to the world of conventional portfolio management. This means allocating not 1 or 2% of your capital, but 10, 20, or even more to a single idea. This is the moment that separates the academic from the warrior, the analyst from the owner. And no story in Warren Buffett's career demonstrates this courage to concentrate more dramatically than his monumental investment in the Coca-Cola Company in the late 1980s. By 1988, Warren Buffett was already a legend, and Berkshire Hathaway was a massive enterprise. He was no longer a young, nimble partnership manager. He was managing billions of dollars. The law of large numbers dictates that it becomes much harder to achieve outstanding returns as your capital base grows. To move the needle for Berkshire, Buffett couldn't make small bets. He needed an idea of immense scale. He found it in one of the most well-known companies on earth. Buffett had been a fan of Coca-Cola his entire life, drinking multiple Cokes a day. He had admired the business from afar for decades. He understood its simple, brilliant model, selling a syrup concentrate to bottlers all over the world, who then did the heavy lifting of bottling and distribution. But for years, the stock price had been too high. Then came the stock market crash of October 1987, Black Monday. The market plunged, and in the ensuing fear and volatility, even the stocks of the greatest companies in the world were dragged down. Coca-Cola's stock fell by more than 25%. For Buffett, this was the fat pitch he had been waiting for. The crash had not changed the fact that billions of people around the world still loved the taste of Coke. It had not damaged the company's unparalleled brand recognition or its global distribution network. The business was just as wonderful as it had been a week before the crash, but the price was suddenly much more attractive. He began his work. He read decades of the company's annual reports. He studied its international growth prospects, realizing the immense untapped potential in markets like China and India. He analyzed the power of its brand, concluding it was perhaps the most valuable in the world, a permanent fixture in the minds of consumers. He looked at the brilliant leadership of its CEO at the time, Roberto Goizueta, who was a master of capital allocation. His due diligence confirmed what his intuition had long told him. Coca-Cola was a near-perfect business, a forever company. Now came the test of conviction. It wasn't enough to buy a small, token position. To make a real difference for Berkshire shareholders, he had to bet big. And he did. Over a period of several months, starting in 1988, Berkshire Hathaway bought share after share of Coca-Cola. By the time he was done, he had invested over $1 billion. This was an astronomical sum at the time. It represented more than a quarter of Berkshire's entire portfolio value. He had concentrated his company's capital into a single stock with a level of conviction that would have sent a shiver down the spine of any financial advisor. He wasn't just dipping a toe in, he was backing up the truck. This was the punch card philosophy executed on a grand scale. He did the work, he waited patiently for the right price. And when the opportunity presented itself, he acted with overwhelming force. The result was one of the most successful investments in history. Berkshire's billion-dollar investment in Coca-Cola grew more than tenfold over the next decade, creating over $10 billion in value for his shareholders. The dividends alone have repaid his initial investment many times over. The Coca-Cola story is the ultimate lesson in the courage to concentrate. It demonstrates that once you have done the deep due diligence and have an unshakable belief in a business, the riskiest thing you can do is not bet heavily. Diluting your best idea with dozens of mediocre ones is a surefire path to mediocrity. True wealth creation, the kind that transforms your financial life, requires the courage to occasionally put a very large portion of your eggs in one basket, after you have inspected that basket with a microscope and concluded it is woven from steel. The immense psychological challenge of concentrating your capital, of placing a significant portion of your net worth on a single outcome, requires conquering one of the most powerful biases in behavioral finance, loss aversion. First identified by psychologists Daniel Kahneman and Amos Tversky, loss aversion is the tendency for human beings to feel the pain of a loss approximately twice as powerfully as they feel the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This deep-seated evolutionary bias makes us inherently risk-averse, especially when it comes to large sums of money. The idea of a concentrated portfolio is terrifying to most people precisely because of loss aversion. If you have 50 stocks and one goes down 20%, the impact on your total portfolio is negligible, and so is the psychological pain. But if you have only 5 stocks and your largest holding goes down 20%, you feel that loss acutely. It's a significant drop in your net worth. To protect ourselves from this potential pain, we gravitate towards the false comfort of diversification. Spreading our money thin feels safer. It's a psychological safety blanket that soothes our loss-averse brains. The problem is that this safety comes at the cost of any real potential for upside. In order to bet big, you must consciously and deliberately override this innate fear of loss. The punch card philosophy helps you do this by reframing the very definition of risk. It teaches you that true risk is not short-term price volatility, it is the permanent loss of capital. And the greatest protection against permanent loss of capital is not diversification, but knowledge. When you have done the obsessive due diligence required to earn a punch, your conviction is no longer based on hope or emotion. It is based on a deep, factual understanding of the business and its value. This knowledge acts as a psychological bulwark against loss aversion. When your concentrated position in Coca-Cola drops 20% in a market downturn, your loss-averse brain will scream, "Sell! Stop the pain!" But your rational, well-researched brain will calmly reply, "The price has dropped, but the value of the business has not. Billions of people are still drinking Coke. The brand is still intact. This is a temporary fluctuation, not a permanent impairment of the business. In fact, it might be an opportunity to buy more." This ability to distinguish between price and value is the key to withstanding the psychological pressure of concentration. It is only possible when your conviction is rooted in hundreds of hours of research. Without that foundation of knowledge, loss aversion will always win, and you will inevitably sell at the worst possible time. Another psychological principle at play is what is known as ambiguity aversion, the tendency to prefer known risks over unknown risks. Diversification feels like a known risk, the risk of achieving average returns. Concentration feels like an unknown risk, the potential for both spectacular gains and spectacular losses. The punch card process is designed to systematically turn the unknown into the known. The deep due diligence process is an exercise in eliminating ambiguity. You are peeling back the layers of a business until there are very few unknowns left. You understand the risks, you've quantified them, and you've concluded that the potential reward more than compensates for them. You are transforming a seemingly ambiguous high-stakes bet into a well-defined, high-probability investment. The courage to concentrate, therefore, is not about being a reckless risk-taker. It is about being a professional risk manager. It's about having the intellectual and emotional fortitude to act decisively on the knowledge you have so painstakingly acquired, and to refuse to let the primitive, loss-averse parts of your brain talk you out of your best ideas. It is the final, crucial step in translating research into returns. To apply the principle of concentration, you need a practical framework for position sizing. How much is too much? How do you decide whether an idea is worth a 5%, 10%, or 20% allocation? This blueprint will help you translate your conviction level into a concrete portfolio management decision. This is not a rigid formula, but a mental model for thinking about capital allocation in a concentrated portfolio. Step 1 is to grade your conviction. Not all good ideas are created equal. You must learn to differentiate between a solid idea and a truly life-changing opportunity. A simple way to do this is with a 3-tier grading system. A C-grade conviction is an idea that meets all your checklist criteria but has some lingering questions, or a slightly smaller margin of safety. An A-grade conviction is an idea that you feel you understand inside and out, that has a massive moat, exceptional management, and is trading at a significant discount to your conservative estimate of its value. You might even have a rare A-plus conviction, an idea so compelling it feels like a near certainty. This grading is subjective, but the process of forcing yourself to assign a grade is a valuable discipline. Step 2 is to link these grades to a range of position sizes. This is your personal asset allocation policy. For example, you might decide that a C-grade idea will never be more than 5% of your portfolio at cost. A B-grade idea could be between 5% and 10%. And an A-grade idea, one of your true punch card moments, could be between 10% and 20%. You might even reserve a special, higher allocation, say up to 25%, for that once-in-a-decade A-plus opportunity. These percentages are not magic. You should adjust them to your own risk tolerance. The key is to have a predefined structure. This prevents you from making emotional sizing decisions in the heat of the moment. It provides a rational link between the quality of your research and the quantity of your capital. Step 3 is to consider the correlation of your bets. Even in a concentrated portfolio of 5 to 10 stocks, some diversification is prudent. You wouldn't want all 5 of your positions to be in regional banks, for example, as a single industry-wide problem could decimate your entire portfolio. When considering a large new position, ask yourself how it relates to your existing holdings. Is it in a different industry? Does it have different economic drivers? The goal is not to be perfectly diversified, but to avoid concentrating your capital in a single point of failure. A portfolio of 5 great businesses in 5 different, uncorrelated industries is far more robust than a portfolio of 5 great businesses that are all exposed to the same specific risk. Step 4 is to have a plan for scaling in and out of a position. A punch on your card doesn't always have to be a single all-at-once purchase. For an A-grade conviction, you might decide to initially buy a 10% position. Your plan could then be, if the stock drops 20% from my purchase price, and my fundamental thesis remains unchanged, I will add another 5%. This allows you to take advantage of volatility. turning market fear into an opportunity to increase your stake in your best idea at an even better price. Similarly, you should have a general idea of when you would trim a position. While punch card investments are meant to be held for a very long time, if a stock has a spectacular run and grows to become 50% or 60% of your portfolio, it may be prudent to trim it back to a 20% or 25% position to manage risk. This is not market timing. It is disciplined portfolio rebalancing. By establishing this clear blueprint for position sizing, you professionalize your approach to concentrated investing. You move beyond a simple buy decision to a more nuanced strategy of capital allocation. This framework gives you the confidence to bet big because you are doing so within a structured, rational, and risk-aware process. It is the practical instruction manual for wielding the powerful weapon of concentration. The antithesis to the courage of concentration is the path of the 99%, the path of the diversifier. This is the investor who has been so thoroughly indoctrinated with the Wall Street mantra of diversification that they spread their capital across an ever-expanding number of positions, believing that with each new addition, they are making their portfolio safer. In reality, they are making it weaker, more fragile, and destined for mediocrity. The diversifier's portfolio often looks like a miniature index fund. They own a piece of everything. They have the top 5 tech stocks, a couple of big banks, a railroad, a consumer goods company, a utility, and maybe an energy stock for good measure. They feel smart and sophisticated, like they are running their own personal S&P 500, but they have missed the entire point. The reason to actively manage your own money, to do your own stock picking, is to achieve results that are tundra different from the index. By replicating the index in a haphazard way, the diversifier is guaranteeing themselves, at best, index-like returns, but with one crucial difference. They are doing it far less efficiently. They are incurring trading costs and creating taxable events that the index fund manager avoids. They are a closet indexer, paying the price of active management for the results of passive management. This is the worst of all possible worlds. The psychological root of diversification is a fear of being wrong. The diversifier lacks the conviction to make a meaningful bet. The thought of allocating 20% of their portfolio to a single stock is terrifying, because what if they are wrong? The potential loss is too painful to contemplate. So instead, they make 20 tiny 1% bets. This way, if any single bet is wrong, the pain is minimal. But this strategy completely ignores the other side of the coin. By protecting themselves from the pain of being wrong, they have also completely insulated themselves from the life-changing pleasure of being right. Their best idea, their one potential 10-bagger, is neutered, its potential impact diluted into meaninglessness by the 19 other mediocre ideas surrounding it. Another characteristic of the diversifier is what Charlie Munger calls ass-kissing. In the professional wealth management world, many advisors create these overly diversified portfolios not because it's best for the client, but because it's best for the advisor. A concentrated portfolio is volatile. It will have periods of underperformance. During these periods, clients get nervous and fire their advisors. A highly diversified portfolio that hugs an index will never have spectacular returns, but it will also rarely have spectacular drawdowns. It's a strategy designed to prevent the advisor from getting fired, not to maximize the client's wealth. The retail diversifier is essentially doing this to themselves. They are managing their money in a way that minimizes the headline risk of a single position going down at the cost of their long-term portfolio growth. They are optimizing for career preservation in a job where they are both the employee and the client. The end result of this path is a portfolio that is an anchor, not a sail. It's a collection of assets so diffuse and watered down that it can do little more than drift along with the market currents. It represents a monumental opportunity cost, the forfeiture of a future that could have been built on the power of a few great ideas, sacrificed at the altar of a false and ultimately impoverishing sense of safety. The direct financial connection between concentration and wealth creation is the most explosive and non-linear part of the entire punch card system. It is where all the previous work, the focus, the discipline, the diligence, is finally leveraged into a tangible and massive financial advantage. The mathematics are simple but staggering. Let's return to our hypothetical $100,000 portfolio. The diversifier puts 2% of their capital, $2,000, into their best idea. The concentrator, after immense research, puts 20% of their capital, $20,000, into that same idea. Let's assume the idea is a home run, a 10-bagger that increases in value by 900% over the next decade. For the diversifier, their $2,000 position grows to $20,000. They have made a profit of $18,000. This is a nice gain, but it only increases the total value of their initial $100,000 portfolio by 18%. It's a minor event. Their life has not changed. For the concentrator, their $20,000 position grows to $200,000. They have made a profit of $180,000. This single investment decision has nearly tripled the value of their entire original portfolio. This is a life-changing event. This is the down payment on a house. This is paying for a child's college education. This is the achievement of financial freedom. The financial output is 10 times greater, simply as a function of the initial capital allocation. This is the brutal leverage of conviction. This effect becomes even more pronounced when you consider a lifetime of investing. The goal of the punch card investor is not to find one 10-bagger. It is to, over a period of 40 or 50 years, find just 4 or 5 of them. If you can successfully identify just a handful of these extraordinary businesses and have the courage to make them significant positions, the compounding effect is astronomical. A portfolio built on a few concentrated winners will not just outperform a diversified portfolio, it will operate in a different financial universe altogether. Furthermore, concentration has a direct and positive impact on your return on time invested. The diversifier with 50 stocks cannot possibly keep up with the developments of each company. They are perpetually behind, unable to properly monitor their many holdings. The concentrator, with only 5 to 10 positions, can afford to treat them like a true business owner. They can listen to every quarterly conference call, read every industry report, and maintain a deep, up-to-date understanding of each of their investments. This superior monitoring allows them to make better decisions, to know when to hold through a downturn, and, just as importantly, to recognize when the fundamental thesis for owning a business has changed and it's time to sell. This high return on a manager's time is a hidden but critical financial advantage. It reduces the odds of being blindsided by negative developments and increases the odds of letting your winners run for the long term. Ultimately, the financial power of concentration is about making your insights matter. All the brilliant research in the world is financially irrelevant if it is not backed by a meaningful allocation of capital. Concentration is the bridge between a great idea and a great result. It ensures that when you are right, you are very, very right, and that the financial rewards are proportionate to the quality of your intellectual labor. It is the engine that drives the entire punch card system, transforming it from a theoretical exercise in stock picking into a practical, real-world machine for building extraordinary wealth. We arrive now at the fifth and final pillar, the one that ties everything together and allows the magic of compounding to take hold. This is the long-term partnership mindset. Once you have used extreme focus to identify an opportunity, applied the discipline of no to protect your capital, completed the obsessive due diligence to build conviction, and had the courage to concentrate your bet, you must do the hardest thing of all: nothing. You must shift your thinking from that of a stock trader to that of a silent partner in a business. You have not bought a flickering quote on a screen. You have bought a piece of a living, breathing enterprise, and your intention should be to hold that partnership for years, if not decades. This mindset is the ultimate key to unlocking the power of long-term portfolio growth. The quintessential story of this buy and hold forever partnership mentality is Warren Buffett's investment in the Washington Post Company. This was not just a financial transaction for him. It was a deep, personal, and decades-long relationship with a business he loved and a family he admired. In the early 1970s, the stock market was in a deep funk. It was the era of the Nifty 50 collapse, stagflation, and widespread pessimism. In 1973, Buffett, through Berkshire Hathaway, began buying shares of the Washington Post Company. The company was run by Katharine Graham, a woman Buffett deeply respected for her integrity and courage, especially during the paper's reporting on the Watergate scandal. At the time, the entire company had a market capitalization of around $80 million. Buffett saw this as absurdly cheap. He knew the company's assets, which included not just the famous newspaper, but also several valuable television stations and Newsweek magazine, were worth many times that amount. He did his usual deep dive. He understood the newspaper industry's economic franchise characteristics. In most cities, the dominant newspaper was a local monopoly, an essential toll booth for local advertisers. He saw the immense value of the television stations, which were veritable licenses to print money. He concluded that he was buying a collection of world-class assets, run by world-class people at a ridiculously low price. He punched his card. Berkshire invested about $11 million, acquiring a large stake in the company. Then came the true test of the partnership mindset. For the next several years, the stock did absolutely nothing. The market remained pessimistic, and the price of Washington Post stock languished. A typical investor, a trader, would have become impatient. They would have sold their position to move on to something more exciting. But Buffett was not a trader. He was a partner. He wasn't focused on the stock price. He was focused on the business. He saw that Katharine Graham was continuing to run the company brilliantly. The newspaper was growing its circulation. The TV stations were increasing their advertising revenue. The intrinsic value of the business was steadily climbing, year after year, even if the stock price was not reflecting it. He was content to wait, knowing that eventually the market's voting machine would catch up to the business's weighing machine. And it did. As the market recovered and the company's earnings power became undeniable, the stock price began a monumental ascent. That original $11 million investment, which Berkshire held for over 4 decades, grew to be worth over $1.2 billion by the time they sold it, only after the Graham family sold control of the company. That's a return of over 100%. But the story is deeper than just the numbers. Throughout those decades, Buffett served on the Post's board of directors. He became a close friend and mentor to Katharine Graham and her son, Don Graham. He wasn't just a passive shareholder, he was a true partner, offering his wisdom and support. This is the ultimate embodiment of the 5th pillar. It is the understanding that a punch on your card is not a trade, it is a marriage. It is a commitment to a business and its management, a commitment to ride out the inevitable storms of market volatility and economic cycles, and to participate in the long, slow, miraculous process of value creation and compounding. The psychological discipline required to maintain this long-term partnership mindset is perhaps the most difficult of all, as it requires battling biases that are deeply ingrained in our perception of time and risk. The first and most powerful of these is hyperbolic discounting. This is our brain's tendency to prefer smaller, sooner rewards over larger, later rewards. We would rather have $20 today than $100 a year from now. This is why people struggle to save for retirement and why diets are so hard to stick to. The immediate pleasure of the cookie outweighs the long-term abstract benefit of being healthy. In investing, this bias manifests as an obsession with short-term performance. We crave the quick win, the stock that doubles in 3 months. The idea of buying a stock and holding it for 10 years, even if the potential return is enormous, feels psychologically unsatisfying. The reward is too far away, too abstract. A punch-card investor must wage a constant war against this instinct. They must train their brain to find satisfaction not in the quick, sugar high of a short-term gain, but in the slow, patient accumulation of value. This requires a fundamental shift in one's time horizon. You must learn to think in terms of decades, not quarters. You must visualize the future reward so vividly that it becomes more compelling than the immediate temptation to sell for a small profit or to cut a position during a downturn. The second major psychological hurdle is what's known as myopic loss aversion. This is a combination of loss aversion and the tendency to evaluate our outcomes frequently. If you check your stock portfolio every day, you are subjecting yourself to a constant stream of small gains and small losses. Because losses feel twice as painful as gains, this daily monitoring results in a net negative emotional experience. The constant small pains of daily volatility make you more likely to make a rash, emotional decision, like selling a great company during a temporary dip. The partnership mindset is a direct cure for myopic loss aversion. If you are a partner in a private business, you don't get a price quote on your ownership stake every second of the day. You might only get a valuation once a year. This infrequency of evaluation allows you to focus on what truly matters: the long-term health and performance of the business. A punch card investor should strive to adopt this same mentality. After making an investment, you should consciously resist the urge to check the stock price daily. Instead, commit to a less frequent review schedule. Perhaps you read the quarterly and annual reports, focusing on the business results, not the market's reaction. By reducing the frequency of your emotional check-ins, you numb yourself to the meaningless short-term noise and allow yourself to focus on the long-term signal. This builds the emotional resilience needed to hold on for the long haul, to ride out the 30%, 40%, or even 50% drawdowns that even the best companies will inevitably experience over a multi-decade journey. Cultivating this long-term mindset is about building a psychological time machine. It's the ability to mentally transport yourself 20 years into the future and look back at today's decisions. From that vantage point, the daily noise of the market becomes insignificant, and the immense power of holding on to a compounding machine becomes crystal clear. To put this long-term partnership mindset into practice, you need a set of tools and habits that constantly reinforce a business owner perspective and insulate you from the short-term noise of the market. This is the blueprint for marrying your investments. Step 1 is to, upon making an investment, write a business owner's memo. This is an evolution of the one-page investment thesis we discussed earlier. This memo should be written as if you were a private owner, writing to your partners about why you have just acquired this new enterprise. It should detail not just the financial rationale, but the qualitative aspects you admire. What is the company's mission? What is its culture like? Who are its leaders, and why do you trust them? What do you hope this business will look like in 10 years? This document should be personal and detailed. It solidifies the emotional and intellectual bond with the company, shifting your identity from stockholder to business partner. You should save this memo and reread it at least once a year. It will serve as a powerful anchor during periods of market turmoil, reminding you of the fundamental, long-term reasons you committed your capital in the first place. Step 2 is to create a business performance dashboard, not a stock price tracker. For each of your concentrated holdings, create a simple spreadsheet or document that tracks the key metrics of the underlying business, not its stock price. You might track quarterly revenue growth, profit margins, return on invested capital, and debt levels. This is the information a true business owner would care about. Your goal is to get your dopamine hit from seeing the business perform well, not from seeing the stock price go up. This deliberately shifts your focus from the fickle Mr. Market to the fundamental progress of the company. You commit to reviewing this dashboard only once a quarter, after the company has released its earnings report. Between those periods, you ignore the stock price completely. This is a powerful habit that severs the link between your emotions and daily market volatility. Step 3 is to adopt the gardener's mentality. Think of your portfolio not as a collection of tickers, but as a small, carefully cultivated garden. You have planted a few exceptionally promising seeds. Your job now is not to pull them up every day to see if they're growing. Your job is to occasionally water them by reading the annual reports, ensure they are getting enough sunlight by checking that the industry remains healthy, and pull out any weeds that might threaten them by watching for new disruptive competitors. But mostly your job is to be patient and let them grow. Some years they will grow quickly, other years they may not grow at all. But if you have chosen strong, healthy plants and put them in fertile soil, over a decade or two, they will grow into mighty trees. This mental model encourages patience and a long-term perspective. It reframes periods of no growth not as failure, but as a natural part of the cycle. By implementing these three practices, the owner's memo, the performance dashboard, and the gardener's mentality, you create a powerful behavioral architecture. This architecture is designed to support the long-term holding period that is absolutely essential for unlocking the full, explosive power of a high-conviction, concentrated investment strategy. It is the final piece of the puzzle, the operating system that allows your brilliant investment decisions to compound into true, generational wealth. The antithesis of the long-term partnership mindset is the frantic, destructive path of the panicked trader. This individual may have done everything else right. They may have identified a great business, done their homework, and even made a reasonably sized bet, but they lack the final, crucial ingredient, the emotional fortitude to hold on. They confuse stock price volatility with business risk, and in doing so, they snatch defeat from the jaws of victory, time and time again. The panicked trader is a slave to the stock ticker. They have it open on their screen all day long. Every little uptick brings a thrill of excitement. Every downtick brings a jolt of fear. Their emotional state is directly tethered to the meaningless random walk of the market. They are playing a long-term game with a short-term scoreboard, a recipe for guaranteed failure. Let's trace their journey. They buy a wonderful company, Company A, at $100 per share, believing it's worth $200. The stock then goes through a normal market correction and drops to $70. For a long-term partner, this is a non-event, perhaps even an opportunity. For the panicked trader, it is a catastrophe. Their loss aversion kicks into overdrive. The pain of seeing their position in the red is unbearable. All their previous research goes out the window, replaced by a single, overwhelming emotion: fear. They sell at $70, locking in a 30% loss, telling themselves they are, quote, cutting their losses. A year later, the market recovers, and Company A's strong business performance shines through. The stock is now at $150. The panicked trader, seeing it run, is now gripped by a new emotion: regret mixed with FOMO. They buy back in at $150, having sold at $70. A classic buy high, sell low maneuver. This cycle of fear and greed is the defining characteristic of the panicked trader. They are constantly whipsawed by the market's emotional currents, making pro-cyclical decisions that destroy their capital. They sell when they should be holding or buying more, and they buy when they should be patiently waiting. They treat their best ideas like disposable flings rather than lifelong commitments. The root cause of this behavior is a fundamental misunderstanding of what a stock is. They see it as a piece of paper to be traded, not as a fractional ownership of a business. They have never internalized the partnership mindset. They don't think like an owner. If they owned a successful local restaurant and it had one slow month, they wouldn't immediately sell the entire business for a 30% discount. They would understand that businesses have ups and downs. But when it comes to the stock market, this common sense evaporates, replaced by a primal fear driven by the constant, flashing red numbers on a screen. The long-term cost of this behavior is staggering. It is not just the losses they crystallize. It is the monumental opportunity cost of what could have been. The panicked trader is the person who bought Amazon in the early 2000s and sold it after a 20% gain. They are the person who owned Apple but sold it in the 2008 crisis. They may have had the right ideas, but they lacked the temperament to profit from them. Their portfolio is a graveyard of brilliant ideas that were abandoned prematurely. It is a testament to the fact that in investing, temperament, the ability to withstand psychological pressure, is ultimately more important than intellect. The panicked trader is the tragic final boss that every investor must defeat within themselves to achieve success. The direct financial connection between a long-term partnership mindset and your final wealth is the most powerful force in all of finance. The magic of untaxed, uninterrupted compounding. This is not a small incremental advantage. It is an exponential force that creates a vast and unbridgeable chasm between the patient partner and the panicked trader over time. Let's quantify the miracle. Imagine you invest $10,000 in a great business that manages to compound its intrinsic value at 15% per year. You are a true partner and you hold this investment for 30 years, never touching it. At the end of 30 years, your initial $10,000 will have grown to over $662,000. Now consider a panicked trader who invests in the exact same business. They get nervous during a market downturn in year 5 and sell, then buy back in a year later after the price has recovered, effectively missing 1 year of compounding and incurring some frictional costs. They do this again in year 12 and again in year 22. These few seemingly small interruptions in the compounding process have a devastating effect. Their final sum might only be $300,000. They own the same asset, but their lack of patience cut their final wealth in half. The real financial magic happens when you combine concentration with this long-term mindset. Let's take the Coca-Cola example. Buffett's $1 billion investment grew to over $10 billion in a decade. But he didn't sell. He continued to be a partner. Today, that position, through stock splits and reinvested dividends, is worth over $25 billion. The majority of the wealth created from that single punch card decision came time the first decade. It came from the long, slow, patient process of letting a great business do what it does, year after year, without interruption. This long-term hold also creates a massive, direct financial benefit through tax deferral. As we discussed, by not selling, you are allowing your entire pre-tax capital to work for you. That 15% or 20% of your gains that would have been siphoned off by the government each time you sold a winner remains in your account, itself generating further returns. It's like having an interest-free loan from the government that you can invest for your own benefit. Over a multi-decade holding period, the value of this tax deferral is immense. It is a powerful structural tailwind that the panicked trader, with their constant buying and selling, never gets to experience. They are in a perpetual battle against the headwind of taxes. Finally, the partnership mindset directly impacts the quality of your life. The patient partner, who reviews their businesses quarterly, is free from the daily anxiety and stress that plagues the trader. They have more time, more mental energy, and a greater sense of peace. This psychic income is a real return on your investment strategy. It doesn't appear on a balance sheet, but the value of sleeping well at night, knowing you own a collection of wonderful businesses that are working for you around the clock, is immeasurable. The financial conclusion is inescapable. The greatest fortunes are not built by brilliant trading, they are built by brilliant sitting. The long-term partnership mindset is the master key. It is the final promise that allows you to take a few, well-chosen, concentrated positions and, through the unstoppable, exponential power of patience, transform them into a legacy of true and lasting financial freedom. You have just spent this time investing in a fundamental recalibration of your financial mind. You've moved beyond the noise of Wall Street and the flawed logic of the 99% to grasp a system of thought that has created more wealth than any other in history. The 20-slot punch card is not just a clever trick. It is a complete philosophy for decision-making under uncertainty. You now possess the 5 pillars of this system: the worldview of extreme focus, the discipline of, the mandate for obsessive due diligence, the courage to concentrate, and the fortitude of the long-term partner. This is a powerful mental arsenal that, if applied, can fundamentally change the trajectory of your financial life. You are now equipped to stop being a collector of stocks and start being an owner of businesses. But understanding this one powerful mental model is like learning the rules for a single, crucial piece on the chessboard. You've mastered how the queen moves, and that alone makes you a formidable player. However, the true grandmaster, the investor who can navigate any market in any circumstance, doesn't just understand one piece, they understand how all the pieces work together. They see the entire board. The punch card philosophy is one critical node in a network of interconnected mental models that Buffett and other master investors use to make decisions. It is connected to the concept of the circle of competence, which defines where you are allowed to play. It is linked to the idea of Mr. Market, which governs when you should act. It relies on the PRUI, margin of safety, principle, which protects you from ruin. The video on your screen right now is the next piece of that map. It is the link that connects the what of the punch card to the when and where of a complete investment framework. The journey of mastering an investment philosophy is a process of assembling these models, one by one, until a complete, unbreakable lattice of logic is formed in your mind. The choice you have right now is not just about watching another video, it is a declaration of intent. Are you a tourist in the world of investing, content with a single interesting souvenir? Or are you committed to the ascent, determined to build the entire mental fortress, piece by piece, until you have achieved true intellectual sovereignty over your financial future? If you are ready to continue that climb, to add the next critical weapon to your arsenal, the path forward is right there, waiting for you. Complete the map.